Right, speaking of one of those people that might be a little bit more optimistic about that inflation picture moving forward, we want to bring in Greg Daco. He's EY's chief economist here. Greg, just first of all, your big takeaway from this print, what should we be really taking away in terms of the implications for the Fed down the road?
I think the number one implication of today's CPI report is that we are going to be on a bumpy road. This disinflationary path is not going to be smooth. There are going to be bumps along the way, just like on the inflationary leg, there were bumps along the way. So yes, inflation was a little bit hotter than anticipated, but we're not seeing anything of concern in this report. There is still an indication that if you look at some of the core fundamentals in terms of inflation, we're still on this solid disinflationary path. And I wouldn't be surprised that before the end of the year, we'll be below 3% inflation by the end of this year.
Below 3% by the end of this year. Is that where your target just was?
Yes, I think the headline CPI is likely to be below 3%, and core CPI is going to be very close to that, but may also be below 3% by the end of this year.
Okay, I see a bet coming. I don't think it's going to get below 3 by the end of the year, or even close to it. Shauna, what are the stakes? What are Greg and I betting?
Let's do dinner. Dinner?
Greg, are you game for dinner? Over under is 3 by the end of 23. I'm taking over.
We'll do that. We'll have dinner. I look forward to that.
I look forward to my
steak. Especially on this Valentine's Day, this would be a great thing to do.
I'm looking forward to that steak, buddy. So you talk about a bumpy road ahead. Are we talking about a drop in the S&P? Are we talking about massive job losses? Exactly what do you mean by a bumpy road ahead?
Well, I think on this CPI front, on the inflation front in general, every month is not going to be a downward month. We're going to see months where we see upward momentum in terms of energy prices, in terms of food prices, even in terms of some of the core components. We still have an environment in which shelter costs are rising very strongly. But if you look at the underlying details, even in today's report, half of the headline CPI print on a month-over-month basis was from energy. The other half was from shelter costs. These are not sticky factors. So I think that as we move forward and see further deceleration in consumer spending, that's going to put downward pressure on inflation. My fear right now is what the Fed has done in terms of focusing on extreme data dependence in an environment that is as volatile as what we're seeing, because it's subject to sudden pivots in market sentiment if the data flow does not match its forecast.
So, Greg, what does that mean just in terms of what we could potentially see? What do you think could be the fallout then from that?
Well, listen, we were very much surprised by the January employment report. I think everybody was. That helped essentially tighten financial conditions in the wake of that report. But since then, we haven't really seen any further evidence of much resilience in the economy. Let's wait to see what the next employment report will bring in February, as well as the next CPI report. We will get tomorrow's retail sales numbers, which are likely to be good. But let's remember that retail sales are nominal figures, so they're likely to be inflated by the strong CPI print that we just had. So let's keep in mind that what matters is not the amount of dollars that people are spending, because we know they're spending more given the high inflation environment, but how much goods and services they're really buying underneath those high prices.
Greg, you mentioned shelter up 0.7% month over month, 7.9% year over year. When do you think we see that number begin to come down?
I think the spring is really going to be key in terms of the translation for some of the movements that we've already seen in the real-time housing data. We've seen a significant correction in housing activity that has permeated through housing prices. I think the CPI indicators will start to indicate more of a softening from that. And if you get that leg of CPI inflation that starts to decline, perhaps with accelerating momentum in the spring and into the summer, that's where you could start to see some more rapid falling, more rapid cooling of inflation dynamics. And that's where you will be buying me a dinner before the end of the year.
There we go. We will see who's going to win this bet. Greg, let's talk about a little bit more about the consumer. We'll get the retail sales number out before the bell tomorrow, painting another picture just in terms of the strength that we are seeing there. Are you seeing any evidence of consumers trading down? And what does that indicate to you?
I think what we're in for is a K-shaped spending pattern going into the next few months. The people at the lower to median end of the income spectrum are constrained by high prices. And let's not forget, we focus as economists on inflation, but inflation is still an environment where prices are rising. A lot of people focus on price levels when they go to the grocery store, the restaurant, or wherever. And that is still going to be an environment in which we see these higher prices deterring consumers' ability to spend and therefore forcing them to use more credit or dip into their savings to finance their outlays. The well-off families are likely to continue to be able to spend, albeit at a slower pace. But that's really the trajectory I expect for consumer spending over the next few months.
All right, Greg, I'm thinking Charlie Palmer Steakhouse, maybe Cut Steakhouse. I think that's Wolfgang Puck's, but we'll talk in a couple of months, sir. Good to see you.
That sounds great.
All right.